When it comes to investing, what are the most important concepts to understand? We'll tell you today on Elevate Wealth. Welcome back to Elevate Wealth. I'm Deanne Rosso, President and CEO of Elevate Wealth Advisory, and I'm joined today by our Director of Investment Policy, Rob Fezekas. Hey, Rob.
Hey, Deanne. How are you?
I'm great. Good to have you. So, Rob, we get this question a lot from clients. We get investment questions a lot from clients. So, when it comes to investing, what are the most important concepts to understand?
Well, I'd say there's really two, and those are risk and return and the time value of money. So let's start with risk and return. Okay. Probably the most important thing to know for investors is how closely related those things are, risk and return. And we can see that when we look at the long history of asset class returns, of the major asset classes, stocks, bonds, and cash. So if we look back, say, over a century of data, stocks have really outperformed bonds and bonds have outperformed cash. And one of the reasons for that, one of the main reasons, is that stocks are quite a bit riskier than bonds and bonds are riskier than cash. So when it comes to stocks, they're a lot more volatile. The drawdowns are sharper and deeper and they come more frequently than bonds and cash. And so investors need to be sort of compensated to agree to hold on to something that's risky, and that's exactly what we see. So stocks have really outperformed bonds by probably about 5 or 6% per year over the last century. At the other end of the spectrum, we have, say, short-term Treasury bills. Now, these are among the safest investments that investors can hold. It's pretty hard to lose money in short-term Treasury bills, and they're not very volatile and they're not very risky, but the returns have been a lot more modest. They've really just sort of kept up with inflation, or just a little bit more. So that's really that concept to keep in mind is kind of low risk, low return, higher risk should lead to higher returns. And that is what we've seen.
Right. And you get rewarded for the risk you take.
Exactly.
Right? Okay.
Exactly.
All right. So what about that second concept?
Sure. The second one, which is time value of money. So I read somewhere by somebody a lot smarter than me that the essence of finance is time travel. And I think that's exactly right, because finance is really all about shifting resources between the present and the future and back and forth. And so when we say take a loan out, when we borrow money, we're shifting resources from the future and bringing it back to today. When we invest money, we're doing the opposite. We're taking resources that we have now and kind of locking it up for a certain amount of time and shifting those resources to the future. Now there's a connection between the present and the future, and they call that the discount rate. But we can really think about that as our required rate of return, because as we know, $1 today is worth more than $1 in 5 years or 10 years, and so you're going to need some compensation or some return in order to agree to forego consumption of that dollar today, lock it up for some time, and then get an uncertain amount of money in the future. So you're going to need some kind of expected return to entice you to do that, and so that's really the connection, and that's what we mean by the time value of money.
Okay, so our discount rates are DeLorean.
Right, exactly right, yes.
So
yes.
we can be time travelers, and
yes.
we should. We are when we are good investors. So risk and return are related, and the time value of money, really important things to understand. Thank you so much, Rob, for explaining those things to us today. And if you have questions about investments, about risk and return, what risk you should take, or what that time value of money can do for you, we're here to help. Visit us at elevate-wealth.com and click Let's Talk. We'll see you next time.